Most investors are looking at inflation, but they're looking at the wrong fire. This Friday, one single number, the jobs report, could either ignite a massive stock market rally or trigger a total collapse. Here is why the Fed is officially terrified of the labor market. Welcome back to Macro Move. For the last 2 years, it was all about the CPI, but the script has flipped. Jerome Powell has made it clear the Fed's dual mandate is back in play, and right now, the labor market is the only thing that matters for interest rates. By the end of this video, you'll know exactly which numbers to look for this Friday, the 3 scenarios that could play out for your portfolio, and why bad news might actually be the best news the market has ever heard. To understand why this jobs report is so dangerous, we have to look at the Federal Reserve's pivot. For months, Powell was a one-trick pony. His only goal was crushing inflation. But as we see CPI cooling toward that 2% target, a new monster is waking up: the unemployment rate. If the labor market cools too fast, we don't get a soft landing, we get a recession. This is why every word in the latest Fed minutes pointed toward the labor link. They are no longer just watching prices, they are watching your paycheck. So, what are the danger zones for this Friday? First, the headline NFP number. If we see job gains above 200,000, the market might actually panic. Why? Because it tells the Fed the economy is still too hot, which means interest rates stay higher for longer. But if the number comes in below 100,000, the recession alarm starts ringing. The sweet spot, what analysts call the Goldilocks zone, is between 140,000 and 160,000. That is the narrow path to a stock market. Save next, we have to look at average hourly earnings. This is the hidden labor link to inflation. If wages are growing too fast, the Fed fears a wage price spiral where businesses raise prices to cover paychecks. However, if wages stall, consumer spending, which makes up 70% of the U.S. economy, could collapse. We're looking for a steady 0.3% month-over-month growth. Anything higher, and the tech sector, which is sensitive to high rates, is going to take a massive hit. Scenario 1, the save. Jobs are steady and unemployment stays flat. This confirms the soft landing and stocks likely rally 1 to 2%. Scenario 2, the crash. Unemployment jumps to 4.3% or higher. This triggers the Sahm Rule, a historical recession indicator that has been 100% accurate. In this case, expect a massive sell-off in cyclical stocks. Scenario 3, bad news is good news. A slightly weak report that forces the Fed to promise a rate cut in their next meeting. This is the volatility play that most professional traders are betting on. The labor market is shifting faster than most people realize. If you want to stay ahead of the Fed's next move, make sure to hit that subscribe button and turn on notifications. We'll be doing a full breakdown as soon as the data drops this Friday. My question for you today: do you think a weak jobs report will help or hurt your portfolio right now? Let me know in the comments below. I read every single "the Fed is watching the jobs." The market is watching the Fed, and we are watching it all for you. Thanks for watching Macro Move, and we'll see you in the next update.